let's be honest, every $10,000-$20,000 that you save as a real estate investor, man, that's our fuel. Cash
Yeah.
is our fuel to grow our businesses, and avoiding giving it to Uncle Sam and pushing those liabilities into the future is just an amazing thing. Today I have a friend of mine, a mentor, and I guess you're my consultant. I'm your paid client, Mitchell, but a friend as well. And I very rarely have guests on the show, but Mitchell is on to an expert really in real estate tax. So we're here to talk. We're going to do several episodes, and ideally, I would love to do a monthly or quarterly show with you, Mitchell, where people can write in questions or even call in questions, and we can really analyze and do some live tax consulting on the air, because this stuff is so valuable. I've learned a ton from you. But today we're going to talk about cost segregation. Mitchell, welcome to the Nick Huber Show.
Oh, thanks, Nick. Glad to be here.
All right. So what we're going to do is I'm going to kind of play. I'm going to try to, simplify these things as simply and concise as possible. Our goal is to get people to walk away from here with a clear understanding of a cost segregation study, when to do it, how to do it, why to do it, and when not to do it. And as I start to talk about these things in maybe an oversimplified way, I want you to elaborate, jump in, and we're going to really go deep.
Sure.
So a cost segregation study, what is it for? Who does it? When you get gas on a company card at a pump and it's $100, you write that off as an expense right away. It's all an expense right then that year. When you buy bigger things like vehicles and property, which is what we're going to talk about today, real estate, you can't deduct it all right away when you pay for it. When you buy a $1 million piece of real estate, a commercial real estate, you don't get to deduct it all in year one. What you have is a useful life cycle, useful lifespan that has been set up by the IRS. And they tell you that, okay, that $1 million purchase price, if it's commercial real estate, you got to depreciate over 39 years. You get to deduct 1/39th of that purchase price each year for 39 years. And that's how you write it off against your taxes to offset income.
Correct.
Now, when we go to bonus depreciation and talk about cost segregation, this is where it gets a little bit more complex, because when you buy a building, not the entire building and not the entire property in the land, it's not all exactly 39 years as the useful lifespan. So you can break it down into different lifespans, which is all set up by the IRS. There's guidelines on all this stuff. For example, the land, the dirt, the blank property, you cannot deduct that at all. It has an unlimited useful lifespan. So whatever value is attributed to your purchase price on the land cannot be deducted ever. Is that correct?
That's correct. Yep.
And then I'm going to keep going here. I'm on a roll. And when I get something wrong, you tell me. But what we have is a piece of property. If it's a residential property, it's 27 and a half years. Commercial property is 39 years. But the different parts of the actual building, this is where we have to what's called segregate these different types of the building to deduct them on either faster or slower or bonus depreciated timeframes. So you have windows.
That's right.
You have windows in a building that have less. They're not 39 years. A window is not going to last for 39 years. You have property improvements, ground improvements like landscaping. A landscaping job, or landscaping money that you put into landscaping is not going to last 39 years. So you have useful lifespans where some of these things can be accelerated. It's called accelerated depreciation. You can depreciate them faster. Let's say an engineer comes in. This is where the cost seg study comes in. An engineer comes in and says, all right, this $100,000 that you spent on landscaping and pavement, that's not a 39-year time frame. We can speed that up and we can do it faster.
That's right. So yeah, there are these two types of property. There's 1245 property, which is personal property, and then there's 1250 property within the tax code. That's the building and structural component of building property. I believe a window is actually 1250 property. The other, not to get too far ahead, but the other benefit of a cost segregation, this study where an engineer comes through and identifies component by component of a building and assigns it a value, is that the window, for example, or HVAC equipment, which the IRS considers 39-year property, then becomes identified and is assigned a value. So when you do inevitably have to replace those windows or replace that HVAC before the 39-year term that the IRS assigned to it, It's clearly identified. You get to kind of rip it out and write the whole thing off, and then place the new windows or HVAC into service on your tax return.
Okay, so we might as well just jump ahead and tell everybody what the purpose of all of this is.
Let's go.
I'm Nick. I'm a real estate syndicator. I operate self-storage. I buy $1 million piece of property. I have no idea what parts of that property can be assigned what value. So the easy thing to do, and what most investors do, is just put it on a 39-year depreciation schedule and write off a little over 2% a year of that expense. But
most investors do nothing. They just send a statement to their accountant, and then their accountant goes, "Hey, what's the land value?" And they go, "I don't know." And then you just kind of make something up, and you do the best you can, and it's 2 lines on your taxes. Yeah, improvement, land, and bingo, you're off to the races.
This is where your company, Mitchell, RE Cost Seg, comes in. You've been doing cost segregation studies. I'll give everybody a little bit of background on you. You run a firm, almost 10 employees. You do taxes and consulting and full-on tax prep and planning for over 100 high net worth clients, and a lot of them are real estate investors. You've been doing cost segregation studies for years, and 8 months ago, you launched a firm called RE Cost Seg. And a disclosure here, I'm an advisor in the company. I'm an investor in the company. Mitchell owns most of the company. His wife is the CEO of the company. And you guys have hired now almost 10 folks, experienced engineers, to kind of do these studies. Nick buys a property. I'm going to hire you for a couple $1,000s, and your engineers are going to go through line by line and figure out how I can depreciate this thing as fast as possible. Because if I get to depreciate as fast as possible, it's more tax deductions and less money to Uncle Sam.
That's right. So yeah, it's worth noting that our methodology around doing these studies, the IRS issued what's called a audit review guide to their auditors on how to review a cost segregation study. So the IRS says, here, our auditors, this is the training manual on how to go out and, in an audit situation, review one of these studies out there today. And so we have basically reverse engineered our entire report and our entire process to hit the highest level of IRS scrutiny. So ideally, if you were ever audited, you basically give them the report and it's all in there. And so that was our methodology, is basically how can we, some firms out there will basically use historical data or just run it through an Excel report. We have, licensed engineers on staff who go line by line, item by item, look at the blueprints, look at the inspections, and build this study kind of to the highest standard you can. And yeah, the whole purpose is to segregate the 1245 property from the 1250 property and give the taxpayer the best outcome of giving them the most flexibility to take whatever tax treatment they want out there.
And I'm going to put a link to RE Cost Seg in the show notes, but it's recostseg.com. What you all do differently, and we're a happy customer now because you're not only more affordable, but we don't have to wait 3 months for somebody to fly out to our property to drive around it and take pictures. Instead, we send our property manager out, we FaceTime with one of your engineers, and they take screenshots and they get everything they need on a FaceTime. You guys can turn these things around in less than 6 weeks. Pretty awesome. But let's just talk about the magnitude. Why a cost segregation study? If you buy $1 million property and you depreciate over 39 years, it's 2.56% of the purchase price, or $25,600 write-off year one. That's the straight line depreciation. That's what a lot of CPAs actually recommend, and some do even less. Now, when you do this work to segregate out these expenses, it can be anywhere from 20 to 30%, 15 to 30% of the purchase price, Mitchell. That is what's called accelerated depreciation. And now this is where we need to talk about bonus depreciation and what happens with bonus and what it is. But everything that is under, what's the lifespan of bonus? 15 years?
15 years, correct.
Any piece of particle, any article of that building that's under 15-year lifespan is bucketed into one group, and it's called bonus depreciation, and you get a one lump sum year one write-off for that amount.
That's right.
And
So
I'm gonna say that. I'm gonna
yeah,
say that again. I'm gonna say that again because it's so important. Instead of getting a $25,000 write-off on $1 million piece of property that you acquire, let's say you get a 28% deduction. Instead of 25,000, we have $280,000 of deduction year one. Year one, meaning if I'm going to buy $1 million piece of property, it probably only has $60,000-$70,000 of net operating income. That's a 6 or 7 cap, $60,000 to $70,000 of net operating income. Then I got to pay interest. I get the write off interest. So I only have, I have maybe $30,000 of taxable profit, $30,000 of taxable profit, and a $280,000 tax loss. So what happens is, as you make more and more money, and this is exactly how you know who, number 45 had a $700 profit on his tax return, despite claiming that he was a billionaire, whatever it might be. This is how real estate investors, myself included, can buy a little bit of property every single year, get massive bonus depreciation to offset their gains, and all the previous properties, all the other income that they have coming in life can be offset by this bonus depreciation.
That's right. And to your point, as a real estate syndicator, as a promoter, this all works because of bank leverage, it works in part because of bank leverage that, you bought this $1 million property. Well, you put $300,000 down and you borrowed 700,000. And so in your example, the 280 is pretty well matched with the $300,000 you put down. So in concept, you're trying to match capital outflow to tax depreciation, because you actually had to come up with the money to go put it into this building to go buy it.
That 280,000, the 300,000 that I put into that building was profit that I made somewhere else. So
bingo.
That was probably taxed. But if I invest that $300,000 to buy a $1 million property and I get $200,000 deduction year one, it's basically every dollar that I spend is a deduction, a dollar off. But I'm not buying a truck, something that's fun, something that's going to depreciate in value. I'm literally buying an income producing asset for $300,000. I'm getting nearly a $300,000 year one. This
right off. Yeah.
This makes real estate incredibly efficient.
Correct. Yeah. You're creating what's called a deferred tax liability. Like you took a deduction today that you would have been entitled to for the next 15 years in this example. So, but you're taking the tax deduction coupled with the capital outlay. You're still going to have this nominal depreciation every year off of the rest of the asset. I mean, the rest of the asset is still divided by.
Then we have 720 left.
Yeah, and but your deferred tax liability is to the government, and it's deferred. Like, you're not being charged interest on it. They're not coming after you. It's totally legal. It's totally within the rules of the law. You're allowed to do this. And in real estate, you have so much debt in so many areas, and your cost of capital and your cost of debt, especially in today's market, is so expensive. This is a great way to build to think of it as kind of like a mezz debt product.
And this is something that on $1 million property, we're going to spend less than $3,000 on this study. We're going to pay the engineers less than $3,000. It's probably a reasonable amount, maybe a little bit more if it's an intricate multifamily property. But yeah, you can buy literally a $200,000 Airbnb, a rental property, and you can pay already costs like what, $1,000, $1,200, $1,500 to come in and get this study for you that you can confidently take these deductions. It's not your CPA flying by the seat of their pants and doing a back of the napkin, depreciation schedule. This is done by engineers. So let's talk about, you have an example in front of you, I think. One of the properties that we bought at Bolt Storage. Let's just run through, just so that people can really understand, what are these deductions, what part of the building, what values to be assigned to what actual things in this property. What was the total purchase price of this property in North Georgia?
This was $3.8 million.
Okay, so we bought $3.8 million property. Let's assume on the back end, we probably used 50% leverage, but let's assume in a normal time when it's not negative leverage and real estate's not, the cap rates aren't as spread. Let's assume of $3.8 million, we put, we put 1.1 million down, like 30%, $1.14 million of our cash we put into this deal to buy it. Now, what did we learn when the engineers took over and started to look at, cost segregating the expenses?
So the land value came out to about $1,050,000. So then you were left with about, call it 1.1 million of land value. You're left with 2.7 million of improvement basis. Okay. So that's an important distinction. You can never depreciate land. Land is the ground that sits under the property.
How does your team go about assigning that value to land, figuring that out?
There's several kind of methodologies. That the most ironclad kind of IRS accepted method is to use the county appraisal district, a third party kind of government appraiser that is generally the IRS will just accept that value. And so if your property on the tax rolls that you bought for 3.8 million was 2 million, which is often the case, that the county values the property for far less than the fair market value, then we extrapolate the land versus improvement ratio at the county level to the purchase price.
Perfect.
If that is way off, if that's way off, we use a broker opinion of value, or we tell the client, hey, give us the value, but now we can't. This is the risk out there.
That's why it's a lot of work, right? And I think 2.7 million is left. So let's go over that now and figure out at what schedule, and then we'll talk a little bit about the bonus depreciation in the specific property.
So yeah, I mean, you were looking at 2.7 divided by 39, is the base case. That's going to be
70 grand a year.
70 grand a year. And the first year it was actually going to be 26 grand because it was put into service further toward the end of the year. Mm-hmm. So it was put into service in August.
Okay.
So we were able to find 5-year property value of about $650,000. That's,
and what's an example of a piece of, if I'm standing and looking at a storage facility, what's an example of a 5-year property?
On storage facilities, the huge one is the interior walls. If they're all movable, if the entire inside of the storage is all of that corrugated metal, the modular corrugated metal, that is all 5-year property. So one of yours that we didn't have a great outcome, it was cinder blocks. It must have been an older one. They don't really build them like that anymore. But so the idea
what about the overhead doors, like the rolling garage doors, are those 5 years?
Rolling garage doors are all 5-year. Yep. Okay.
So those are huge expenses. That's a major steel outlay and a door. And on a multifamily property like an apartment, what's an example of a 5-year property there?
Appliances are a big one. A lot of flooring carpet can be 5 or 7, and so 5 and 7. 5 is typically like machinery, equipment, and kind of short life things with motors in them. Typically, a car would be 5 years. 7 is a lot of furniture and fixtures. A ceiling fan, light fixtures, things like that.
So your team of engineers is literally going through these buildings on FaceTime, taking screenshots of these things that, we know. Oh, look at that.
Yep.
Here, we know that we can depreciate that faster. We know that's 5-year. We know that's 7-year.
Yep.
And what about the bollards? What about the bollards and retaining walls and like earthwork and like some improvements that we've made to the actual, driveways and things like that?
Yeah. So all the landscaping and all the site improvements are 15-year. So that becomes an immediately depreciable expense.
Our first asset was bought in Ithaca, New York, and we built it on a slope, and we had a huge amount of retention. We had a huge retention pond. We had to do a ton, like over $500,000 worth of bulldozer work and like underground culverts and things to control the stormwater runoff. And we had an amazing outcome. I kind of wish we were using that as an example here, but we had over 30% of our all-in costs were bonus, which was unbelievable.
Well, I mean, so you're going to get into the 15-year, and this one is $409,000, and that's typically that's 15% of the total improvement value, which is probably a lot of parking lot, a lot of foundation, a lot of gates and signs. Or signs would be, I think, 5-year, but a lot of these improvements that you've made to the property, generally everything outside of the facility that you do to make the property safe, secure, clean, is all 15-year, or it's just, a repair.
All right, so we got 2.7 million of the total purchase price. What ended up being? Let's talk about bonus depreciation first. 2017, the CARES Act. Bonus depreciation has been in and out, meaning anything under a certain percentage of that bonus depreciation. It's actually going to change in 2023, which we can talk about. But of that 2.7 million, how much of it was actually 15-year or less?
So yeah, the purchase was 3.8. Then we got to 2.7 of improvement, and we have definitely over 1 million, about 1,050,000 or over 1,050,000 of immediate depreciation. So the cumulative year one depreciation is 1,078,265.
So that's 28.3% of the total purchase price. Even though we got bank debt on a big chunk of it, so the bank is helping us buy this thing. We get to enjoy 28% of our total liability year one depreciation. Now let's talk about bonus, when it came about, where it's at right now.
So yeah, like you mentioned, since the beginning of my career, bonuses becoming in, bonuses going out. Bonus was allowed a while back on tenant improvements, which was a big thing.
And to step back, to zoom out even more, like, what is bonus depreciation? I'll do my best to explain it. Mitchell, you correct me. Bonus depreciation is an incentive by the IRS. The IRS is incentivizing the people who own, maintain, build, and invest in our infrastructure. The government knows that people live in houses, they work in houses, they eat in houses, they go to hospitals, and those are buildings. So they're going to say, oh, we might as well motivate these people from a tax perspective to build, to buy, and to maintain, and to own real estate. I think it's a very important part of our country. I would agree. I own a lot of real estate. But they're going to say, all right, what incentives can we give them from a tax perspective? So they're going to say, let's let them, all this stuff that's under 15-year life, let's let them write off a certain percentage of that all in year one, right when they buy it, right when they make that investment. Let's let them write that off year one, defer those taxes into the future right now. And that's bonus depreciation. Now, bonus depreciation goes from 100% of that. It's been 20% of that. It's been 50% of that. Next year, it'll be 80%. So if we take that 15-year and under, which is $1,050,000 of our purchase price, back in 2007 or 2006, that was what, 20%, Mitchell? We get to write off 20% of that year one. 2017, the CARES Act, and that was just, I made that up. I don't know what it was back in the history, but that's just a point of it. It's been different amounts for different times. 2016, who gets elected? Pro-business, let's go. Boom, the CARES Act of 2017, tax, big tax changes and bonus depreciation. Boom, 100% once again for real estate investors. And that means that 1,050,000 that we figured out is 15-year and under, 100% of that gets to be written off in year one.
That's right. So, just to zoom out and go fully boring, normal depreciation for taxes is on this. Yes, the 27.5 and the 39-year are taken straight line. You just take, the value divided by 40, or 39 as it were, the value divided by 27.5. For this 1245 property, they've always used something called double declining balance, which is this Maker's system. Maker's stands for, I think, modified accelerated cost recovery system. So basically, like your 5-year property, you would deduct 20% the first year, 32% the second, 20% the third, 11% the fourth.
It's always been able to accelerate depreciation based on those useful lives. So there's always been a need for a cost segregation study, get engineers to show us how fast we can do this. And instead of 2.56 year 1% write off, if it's divided by 39 years, we might get 6%, 7%, even without a bonus depreciation kind of add on.
Exactly. The idea is that, in this example that we were looking at for you, even then, the 5-year property is $650,000. And you're going to deduct essentially the first 70% of that in the first 3 years, 75% of that out there in the first 3 years. So because they just know that most of the useful life of property gets plowed away in the first couple years of it.
So
You
what
drive
happened
the
in
car off the lot.
2017? What happened in 2017 in the CARES Act to kind of
So
schedule out bonus depreciation?
yeah, I mean, they made several changes, and really it was just bonus everything. And the big thing was bonus used property. So before 2017, you could not take bonus depreciation on used property. So obviously the
You
new
had to build
build.
it from scratch. You had to build something from ground up to
Yeah.
get it. Like I
So
can't go buy a storage facility and do bonus.
So before 2017, you would buy this storage facility, and yeah, we would go cost seg it, and cost seg has always been a thing, but yeah, you weren't letting it rip year one. You were having to take all of these all of these components, these 5, 7, 15-year components out there, and deduct them over the life of the component level asset. But yeah, 2017 was, hey, even if you're buying a used truck or a used storage facility, as it were, you can just let the whole thing rip. So
Wow,
yeah, before that, you could only bonus new build.
Okay, so 2017 was 100% bonus. 2018 was
Yep.
100% bonus. 19 100%. Then
Yep.
COVID hit and they adjusted it and extended it another 2 years, correct?
Sure. Yep.
So 2021 and 2022 were both 100% bonus. And
That's
now
right.
it's scheduled to start to taper off.
And so yeah, it's supposed to go in 23 to 80%, meaning of this
1,050,000 this
1,050,000 out there, we're gonna be only able to deduct 810,000 the first year, and then
still
the
very
other
significant and still probably wise to do a cost segregation study, but a little bit.
Oh yeah, I mean, there's no question in the sense of, yeah, you go, okay, you can have $26,000 of straight line depreciation, or you can only take 850. And then you can take the next 250, 240 or whatever, or I'm sorry, 810 and 240.
Mm-hmm.
The 240 is over the 5, 7, 15 year lives.
So it's at 80%. And then what about 24? Do we know what it is in 2024 yet?
Yeah, it goes to 60, then it goes to 40, then it goes to 20, then it goes to, obviously it's supposed to totally wind down
unless
in
DeSantis,
2026.
Unless DeSantis gets elected and decides to have his own little bonus for all of his wealthy friends and just puts it right back in the tax code.
Yeah. So bonus depreciation has always been temporary and has always been looming to wind down. It has wound down, and
it's
then
always on the negotiation table when they're writing the new tax code. Okay.
Yeah.
Now I'm going to ask you a question here. Let's now put our CPA hat on. There's CPAs listening. Let's say, all right, I have a client. They just bought a property. We're going to hire recostseg.com to do this cost seg study. They're going to send me this report. What the hell? What the hell do I do with it as a CPA? Do you guys make it easy to put it in QuickBooks? Like, I know you're giving me the depreciation schedule.
Yep.
But tell me the logistics of how it might work.
Well, like you mentioned, I own a CPA firm as well as owning this company. So I've done the best I can to make it as easy as I can to, we'll give you the data in Excel that you can hand to your accountant, or as the accountant, you can request from, us or the client, depending on how, obviously we have the ability to give it to you. But really, like, yeah, you're going to know that you're going to get an Excel sheet with property component by property component, year by year, cost by cost, that you can, either upload into your system or key into your system. We use Lacert, so we have it set up where it can just directly upload into our tax system, because I'm eating my own dog food over here.
So
but
let's talk about something very interesting and probably the most valuable thing that you've ever done for me as a client, Mitchell. We did a study. We asked all of our LPs, our limited partners. We've raised over almost $50 million from limited partners. We asked them all 2 years ago, and this was your idea, Mitchell. We asked them all, what percentage of you guys are real estate professionals? And we need to talk about that next, because who can use these deductions? It's a different type of deduction. That's something we need to talk about in a second. But we found that over 95% of our limited partners were not real estate professionals. They had no use for a lot of this depreciation. We'll talk about why in a second, but you helped us figure out a way so that we could have a give and take with our LPs, and on certain deals, us as GPs, since we are real estate professionals, we could get a big chunk of the bonus depreciation as part of our offering. That was something really cool.
Yep.
We don't need to talk about that now, but if you're a syndicator and you want to talk to Mitchell about that, I highly recommend it. Now let's talk about real estate professional. These are different types, and I'll explain it as simply as I possibly can. You correct me and you elaborate. There's two types of losses. There might be 3, 4, whatever, but in this example, there's 2 types of losses. There's active losses and gains, active income and active losses, and there's passive income and passive losses, meaning if I'm actively involved in it, it's my W-2, it's a business that I own, those are active gains and they're taxed differently. They're treated differently in the eyes of the IRS. If you've made a passive investment, let's say I've invested in Mitchell's company and I don't do anything in it, which is an example with RE Cost Seg, the money that I earn from RE Cost Seg is called passive income or passive losses since I don't have an active role inside the business. Real estate is almost always called passive losses unless you're an active real estate professional, which is a tax designation that you need to hit a certain number of hours spent on real estate. It needs to be your primary focus, whatever it might be. But if you or your spouse, a lot of people have a spouse that's a real estate professional. If one of the 2 people in your marriage, if you're filing jointly, is a real estate professional, you can use this $280,000 or this $1,050,000 deduction to offset your W-2 income. So that's why this can be so powerful if you're a real estate professional.
Yeah, that's right. And you really do want to know that you can utilize these losses and that they won't just be
just sitting there. They can carry forward. They can carry forward into eternity, though. So, like, you can carry them forward as long as you need to.
They will carry forward into eventually when you sell the property and realize the gain. The other thing is they can offset other passive losses. So your whole passive loss is a bucket. So to your example, the real estate losses could offset the RE Cost Seg passive income out there. Beyond that, the real estate pro status. There's a publication 925 that really clearly states what it is. It's 750 hours. More than half your time working is spent on acquiring, constructing, reconstructing, managing. They have a list of exactly the activities that you can do in real estate and how you can become a real estate professional. So
and this is a really interesting thing to talk about because I feel like it's a very hot topic among CPAs because some CPAs just want to play the safe route, and I talk about this all the time on Twitter. I feel like I've personally employed 6 CPAs in my life.
Ugh.
I feel like 5 of them acted like they worked for the IRS. They didn't want to cost segregate and bonus depreciate properties. They argued with me about expenses that I knew enough about the tax code that I knew that they were clear expenses. They argued that we shouldn't use them. They argued to not just aggressively take advantage of the tax code. And many CPAs with I don't know if it's their personality or what it is, they literally act like and think like and feel like they work for the IRS. You are the first CPA that is working actively for me, willing to walk the line, willing to get aggressive, willing to build a case. And Nick, if we have an audit, you tell me this all the time. Nick, if we have an audit, we're ready for it. It's not a big deal. It's nothing to be afraid of. I'm ready to talk to the IRS. We are ready to prove everything, and we're going to do what we're going to do. And if we get audited, it's not going to be stress at all.
Yeah, it's a weird deal because, obviously I'm a CPA. I run my own firm. I have a bunch of clients. For them all to get audited at once would be terrible, and it would be a big pain and a stress. But being a CPA, it's the toughest time it's ever been in the history of CPAs to be a CPA with COVID, with all of this junk out there. So I'm going to take up for the CPAs, but I know you wrote that tweet out there that CPAs don't want to get aggressive, and it angered the CPA community, right? Is that fair to say? But
everybody said I was cheating on my taxes, which is not true.
Well, and that's the whole thing. Is like, I don't even feel like you're not being aggressive in the sense that you're just, but you're using words just to rile people up, which is fun, But like,
let's talk about recapture. I mean, it's the perfect, perfect cost, segue here into recapture because the argument against the reason. Let's talk about why, in reality, you should not do a cost segregation study and take this big bonus depreciation. I'll say number one is if you're not going to own the property for more than a couple of years.
Yep.
If you plan on flipping the property, there's no sense in taking a huge tax deduction just to pay the recapture taxes the next year or whenever it is that you sell it. But if we explain how recapture works, it's the amount. Obviously, if you haven't depreciated and you haven't written off a certain amount of the purchase price, that stuff stays as your basis. Your basis is
Sure.
there. You're not going to get taxed on that amount. The
So
amount over,
you'll always have the land as basis.
yep.
You'll always
Let's
have
just
that
use this
39.
example. Let's use this
Yep.
example. $3 million purchase price. Let's say we sell it in 3 years for $5 million, Mitchell. So the
Yep.
difference between 3 and 5, that's $2 million that's taxed at capital gains.
Sure.
Because the difference between what we paid and what we bought it for, that's the capital gain. Now, the difference between our original purchase price and our current basis, that's what we depreciated, and that's what's taxed at a 25% recapture rate. Is that said correctly?
Yeah, there's also the ordinary income recapture perspective, which is just the same way you do a cost seg going in, you almost do a cost seg going out. And we do this for clients, by the way, where if you sell your property, you can come back to us and we can kind of rerun it based on the same methodology. And so the issue comes about with like 5-year property, for example, where you write it off year one. And let's say 5 years later, you go to sell it. Well, based on the values that we're prescribing to it on the estimate tables that we use to engineer the cost seg study, it now has a tax basis of 0, but it still has value left in it, in the sense that, I know that it was a ceiling fan that just got written to 0. Well, it had a value then, it still has a value now. Well, the current value of that ceiling fan out there is recaptured at ordinary income rates. Mm-hmm. So yeah, the current value of all that landscaping that you didn't tear out and have to replant is recaptured at ordinary income rates. So there is
income rates, if you're in a high tax bracket, can be over 40%.
It could be more, could be less, but will likely be more. So yeah, recapture, if you're not ready to 1031, assuming 1031 exists, or you're not ready to buy a new property and cost seg it again, but even that it can be a risk in the future, because if bonus depreciation goes away, you may not have the same. There's just a reality that the same way you got an ordinary loss deduction this year, you could have ordinary income when you go to sell the property, but then you'll have 25% on the recapture rate, and then you'll have capital gains rate on the gain from there. But again, the same way that we took the deduction when the capital went out the door, we're paying the tax when all the income presumably comes back. So sorry.
Yeah, we're going to do a totally separate talk on 1031s. But a 1031, if I explain it in 30 seconds here, is when you identify another property and you basically roll your proceeds, you roll your basis into a new property, and it's not seen as a taxable event in the eyes of the government. It's like if you sold Facebook stock for a big gain and you bought Google stock with that same amount of money, the equivalent of that would be taxable in the equities world. But in real estate, it's another loophole that we can take advantage of, another incentive that's put in place by the government called the 1031 exchange. We can roll that $5 million. Say I sell this property in North Georgia for $5 million, but I buy a $6 million property with the proceeds. No taxable event. That's what a 1031 is. We'll talk more about that next time. But let's say recapture. Let's go back to recapture. When should an investor be wary of doing a cost seg study? And when does it make sense? Because you type on Twitter, I'm doing a cost seg study, I'm getting all these bonus depreciations. All these CPAs come out of the woodworks. What about recapture? What about recapture? You should never do this. Recapture. And in my opinion, you correct me if I'm wrong, Mitchell, as a real estate investor, this is an absolute no-brainer here, because I understand what I can do with capital that I get to keep now instead of paying now and saving later. I would rather save money now and pay it later than pay it now and save it later. Because over the next 5 years, if I can depreciate and save these tax dollars, I can turn $100,000 into $150,000 into $200,000 through the investing, through the deal flow, whatever it might be. And even if it's the same, even if I can't multiply the capital,
who
in their right mind would want to pay taxes now instead of later when you can pay taxes later instead of now. I just don't understand it. And it's really hard for me to keep biting my tongue when CPAs are advising their clients who are going to hold property for more than a couple of years to not take advantage of bonus depreciation.
Yeah, bingo. I mean, you just have to walk in eyes wide open that this is a deferred tax liability. And yeah, you can take some of the, you can work it on both sides. You can make it the best for yourself, but you may have some recapture. But again, this is real estate. You have debt to banks. You have debt equity to capital partners. You have equity, which has its own kind of imputed obviously value or rate that you have to pay for it.
If you're running a real estate syndication firm like me and you're averaging a 15 to 30 IRR, every dollar you raise is costing you 15 to 30 cents a year to raise
exactly. So yeah, then you have that whole level of debt as well. So you have debt at every level of the capital stack.
Yep. And then every part of the capital stack costs you money.
And then this is, yeah, debt may not be the word, but it's all costing you money to borrow money. And this is debt to the IRS. It's literally a deferred tax liability, but the IRS is not charging you every year to hold out the money. In fact, you can hold out the money forever. And in fact, you can hold out the money forever and today go die at the end and give the money to your kids tax-free. So it's just basis, one of those.
We will do another episode in Step Up in Basis. So I'll give you 30 seconds on that one as well. Let's say Nick Huber owns, if I'm lucky, let's say I own $1 billion real estate portfolio that has been depreciated down to almost nothing. My basis, let's say I own $1 billion worth of self-storage. This is my dream. Don't hate me for dreaming. Let's say I own $1 billion worth of self-storage, but I've depreciated it down. I've taken tax losses, and it's only got a basis of, let's say, $1 or $2 or $3 million. It's almost depreciated down to nothing. If I sell it for $1 billion, if I do, bam, I'm getting recapture. I'm getting capital gains. I'm getting all these taxes. I'm going to have to pay 20 to 30% of that $1 billion to the IRS. But let's say I die. I'm on a motorcycle. I'm cruising down a mountain.
Oh, no.
Fly off the motorcycle, 89 years old, and I die. And I hand it down to Timothy, who's my son, and my daughter, Julia. And I hand it to the kids. What happens?
Does Everett get any or no? Not Everett.
He's he's on my bad side right now, but he'll get
yeah.
What happens? I mean, it's literally step up in basis, and we create a fair market value. You hire RE Cost Seg to do a study of this portfolio. You get the fair market value, and boom, you have a brand new. It's like they purchased it from you in a tax-free way. It's absolutely incredible. If you can,
we need to do some estate planning because so today the estate exemption is for a married couple, somewhere near 30 million at this point. But you
can hand 30 million down to your offspring, or heirs George getting taxed.
Yeah, George Steinbrenner famously died in that 8-month window where there was no estate tax at all. Several billionaires died at that point in time, but
good planning.
Yeah, good planning. So there are steps along the way, but yeah, it's really just back to that idea of you're going to have this tax liability to the IRS that, again, the same way you took the deduction when the capital went out, the liability to the IRS is going to come due, fortunately, when the deal is sold and presumably when some cash comes into your pocket, and you'll be more excited to pay that tax, or you'll never be excited to pay the tax, but it'll be more feasible to pay that tax at that moment and just know that you were borrowing the money the whole time.
Yeah, it's better. Why would I want to pay the tax the year I am outlaying capital to buy property when I can pay the tax the year I'm getting a nut for selling my property?
Bingo. And so yeah, I think
what we do on Bolt's side is we just keep a spreadsheet of all of our properties. We have our original basis and we have our estimated new basis, which is 70% of that or less. And if we sell, I have that difference, tax at 25%. I just have it. Again, we would hire RE Cost Seg to do the study on the way out. But in my mind, I'm accounting for those taxes that I have deferred now.
So, yeah. And so the CPAs who say it's just going to, you're just going to pay recapture. That's just not a very nuanced take, But
let's use a smaller example. Let's say somebody bought a duplex for $150,000, Mitchell. Let's stop talking about $1 million properties. Let's say somebody buys a duplex or a short-term rental And we do need to do another episode on how short-term rentals can be even better because you don't have to be a real estate professional necessarily to enjoy them.
Correct.
$150,000 duplex. How much would a cost seg cost from RE cost seg? And again, this is inflation is hitting us hard. It's November. It's the slow season for RE cost seg. You guys do seasonal pricing, but November 18th, 2022, if you're listening to this in 2030, don't go yelling at me, but $150,000. What's an example of what a study might cost you and what you might get back as far as losses?
Yeah, obviously, we try to price based on value somewhat, but really there's a minimum effort that goes into doing one of these studies at the level we want to do it. There are some maybe lower cost options that where it's more DIY and it's the quality of the product is not going to match up to having an engineer do the work. And so we have a minimum standard of what we do out there. And
I think you're beating around the bush here, Mitchell. It's $1,000 or $1,500. Is that a reasonable?
$1,200 to $1,500 is the minimum at this point.
$1,500. And if they get 30% of that purchase price in a bonus,
so the biggest component of a property at that low price is what's the land value. You know what I mean? Because if it's $150K and the land value is 10 grand versus if it's $150K,
if you're buying a house for $150,000, the land is probably $10,000 or $20,000. Right? So it's probably very similar. Probably very similar or even under the proportions of my self-storage facility in North Georgia. So let's say they get 30% 15-year bonus. We're looking at a $45,000 tax write-off. Now, that's probably about equal to what you would outlay from a capital standpoint to buy the house. So we're literally talking about the exact. You're talking about paying Mitchell and RE cost seg $1,200 to get a $45,000 deduction that you can either use to offset your active income if you are a real estate professional, and if you're not, this $45,000 nut will make the proceeds from this asset tax deferred for 4 or 5 years probably.
And then again, you're still going to have the remainder, the other 100,000 that's over 27 and a half years. So you're still getting $4,000 a year of depreciation out of it.
Let's say somebody, it's clear that if you bought something, you need to probably try to close on something at the end of the year because it's going to go to 80% next year. So in advice, it's November. We're going to release this on Monday. Get the property bought by the end of this year because you're going to get 100% bonus instead of 80. That's clear advice to take away from this.
Yep.
But also, what if you bought a property in 2020 or 2021? Is there anything that we can do?
So going all the way back to 2018, we can still perform this study. Really, before that September of 2017 date, the issue is that you can't deduct the used property out there, and you've already kind of, even if you built a property even before 2018, call us. But really,
let's just say somebody bought something 5 years ago and they haven't been depreciating it at all. Is there anything that they can do to get on schedule?
So let's say after 2018, if you bought that property and you haven't really been, if you weren't depreciating it at all, you can. We filed this form 3115. We request a change in tax treatment, and we basically run the difference between the depreciation you should have been taking if you made all the correct elections versus the depreciation you were taking, which if it's none, obviously let's get you right. But, the big thing is all these people in 2018, 2019, 2020 who didn't take cost segs. Yeah, they can run the system right now. And if they were just taking one.
What did you say is the number, that form number that you said? Because let's say I'm a CPA listening to this. I just got a new client. He's bought a ton of property over the past 10 years. I want to get on schedule with these depreciation. What's that form?
It's form 3115. It's application for change in accounting method. And the CPAs are going to know that. Yeah. And you basically go, here's what we took, here's what we should have taken. And you run all the depreciation through the current year. So you don't have to go back and amend every tax year going backwards. That's the other argument is, we're going to have to amend 5 tax returns. This is going to not be feasible. Well, it is, because we can just kind of catch it all up this year.
This is the problem. I think so many CPAs just every this is all just work, right? This is work for the
Yeah.
CPA that they might not want to do. So fire your CPA if they're too lazy to do this stuff for you.
Or they don't understand, like they don't understand that they can just charge you for the work, that they can go, hey, I'm going to have to do a lot of work. And that the real estate professional generally will go, well, yeah, it's going to take you a lot of work. Just bill me for it. You're going to
Yep.
save me thousands and thousands of dollars,
So if you are a real estate owner or acquire, go to your CPA and say, what do I need to do? What do I need to do? Tell me what to do. Mitchell, you told me exactly what to do to qualify as a real estate pro. Hey, Nick, keep a spreadsheet. Let's do your time. Let's get it here. Boom. This is easy. We got this. Some CPAs are like, oh, well, you're not. Well, tell me what I need to do to qualify. That's a very easy question. And then go to your CPA and say, hey, I want to do these deductions. Let's get going. It's this form. We need to do this. It's not that much work for you. And it's big money for the real every let's be honest, every $10,000-$20,000 that you save as a real estate investor, man, that's our fuel. Cash is our fuel to grow our businesses, and avoiding giving it to Uncle Sam and pushing those liabilities into the future is just an amazing thing about our tax code.
Especially, I mean, as people are going to get into crunches and as people are having, the only way you go out of business is you run out of cash. And in real estate, you have leverage on every side, and you got to pay your note, and you got to stay in the game, and you got to be able to pay your people and continue to run the thing. This may be cash that's locked up in the form of taxes, and this could unlock some cash for you and help you stay afloat, or help you keep doing deals while the deals are going to get good.
So Mitchell, we're going to do this again. And if you're listening right now and you have a question for Mitchell, I want you to send me an email. You can either record it by audio, and I can play it here. Record a clip that's less than a minute long. Explain as much about your situation. We can make some assumptions. We can get some value out of whatever you might say. Don't go into too much detail, but record a little audio clip on your iPhone. Email it to me at nick@sweatystartup.com, or type a paragraph, no more than 200 words, and send it to nick@sweatystartup.com. Send that email. Me and Mitchell, the next time we get together on this, we'll read your question and we'll answer it, and it'll be really good for everybody. But where can people find you? So we already said recostseg.com. That's where you go to get quotes on getting this cost seg. What's your firm's email address?
Best place to find us is
our website,
or find me. We have baldridgefinancial.com, Twitter @BaldridgeCPA, Twitter @RECostseg. That's where we can talk another time about how we've how you've helped us.
The startup story of RECostseg is awesome.
It really is.
Like I said, you've been doing these for years, and now you have a team of folks who have been doing cost segs for years. But really, it's a company that's 6 months old, and you've already. I mean, how much revenue is RECostseg up to in the past 6 months? And I mean, I know you guys are bringing in, you're solidifying 20 to 40 to 50 grand a week of work here. It's getting really busy. You have 11, 12 employees already?
Yeah, we're up definitely past 10. Maybe you got to get Melanie on here. She knows all the numbers, but and
if we shoot from the hip and guess, I think.
Yeah,
you've had 575 quote requests. I saw you tweet that. Like, you've gotten 575 proposals. Many of these take a while to come to fruition, but you've already secured over 100 clients. Is that right?
Yeah, over 100 clients. Over
like
just kind of booked revenue 350 plus thousand, and we have. It's time.
It's hard to say how profitable, right? Because you guys are investing heavily in talent. You've got 12 or 13 people on the payroll now. So, but it's an exciting future. I'm excited for you. It's a great service, man. I'm telling you what, like, being able to turn cost segs around quick and stress-free without waiting on flights and paying extra for travel. It's pretty awesome.
Especially right now, just the idea. That's one thing we do better than anybody is some of these kind of mid-price houses, but are in remote locations where we don't have to fly out to the middle of Idaho.
I buy an Airbnb in Watkins Glen, New York for 200 grand. Like, there is no feasible way to get a cost seg study done on the market except recostseg.com.
I can't fly out to Watkins Glen and spend a day there and take pictures. I mean, so we really, we start from the appraisal. We start from the inspection. We start with all the county data. We really put that together and take a good go at it. So and then we get on the call.
The proposals are free. Let's talk through the process, Brett. I don't want to get too salesy here, but you put in the property that you bought, how much you spent for it, And then your team in the background does quite a bit of work for free, kind of, right?
Yep. All right. recostseg.com. You hit contact us, and then you put in your name, email, property address, you select the property type, you put the purchase price. That's about it.
And your team
And then
goes
we
through the
go in
records, gets the
yeah,
appraisal, and
we
looks through.
research the property. We do a custom quote. We give you this exact breakdown of what would you get without us versus what are you going to get with us. And then we give you the payback ratio. We discount it for tax, and we say, hey, you're going to pay us $2,500, but you're literally going to save 75 grand, like 30 to 1. Do you want to do it?
Mm-hmm.
And
I don't want to do
no,
it.
you wouldn't want to do that. What about Recapture? So and so then from there you send us the appraisal, you send us the inspection, and we take that information. Like I said, we take a good go at it, and then the final step on the consumer's end is either sending their property manager out or going out and doing the virtual site visit. What we handle site visits for $20 million plus properties. I mean, we can do site visits, but really not for anything below it.
It's efficient. I mean, I'm saving thousands of dollars on cost seg because you're just not passing those costs on to me.
I mean, but if the site is thousands and thousands of square feet on a big property that needs somebody to go out there, we can get out there. But obviously, it's a whole different price structure. But beyond that, then we get on that call, we do the report, we get you the report, and we send you on the road. So it's really a good system and a good product.
This has been incredibly valuable. I think it's probably one of the most valuable episodes that I've recorded in a long time. I really appreciate your time, and
I appreciate you, man.
Is there any last thoughts here that somebody might want to know?
Man, I want to commend you. You look how much you understand about tax. Like, look what you've done to become a pro at what you do. And
this is what is great about having you on my team, but I think you can also attest to this. Like when you're sharing openly on Twitter, as a CPA, as an investor, whatever, people call you better know your shit instantly. People call you out instantly on your bullshit. Yeah. So if there's one little nuance that you don't have right, a smart person is going to correct you. And that makes Twitter insanely valuable. So since I talk about real estate, since I talk about tax, I'm not afraid to put myself out there. I learn a ton. And I'm sure, Mitchell, the same can be said for a CPA, right? I mean, you can learn.
I've been on Twitter for 2.5 years, and I've learned more in 2.5 years of just, again, having to get it right, having to understand the blow by blow detail, because if you get it wrong, somebody's there just to dunk on you, which is helpful.
It's another big part of it is I call it lawyer speak. A lawyer will talk and they'll talk and they'll talk, and they can talk for an hour and they're captivating, and you got to listen. Yeah. But then you get out of the call and you're like, what the fuck did I just learn? I learned nothing. They didn't talk to me anything in simple terms. There's nothing that I could understand. So what I appreciate about you, and I'm sure now that everybody's listening to this appreciates about you, is that you speak English to us.
Yep.
You can actually understand it. So,
and awesome. that's just explain like I'm 5. So,
and man, what's your Twitter handle? Just make sure everybody follows you there, because that's where you're putting out thoughts all day. I know we have at recostseg,
and at Baldridge CPA. Yep. And so
CPA. Well, Mitchell, thanks again, man. We're going to post this and get some good feedback. And again, if you have some questions for Mitchell, we'll do this again. Email me them at nick@sweatystartup.com.
Worth mentioning one last thing. We definitely provide, we have some affiliate relationships or some referral partner relationships with CPAs out there who have listened all the way through this, or financial advisors, or people who have referral networks that want their clients to do this out there. Reach out to us, and you'll appreciate referral
you'll basically
partners.
Give a slight discount that they can pass on to their, if they help us out in some ways, they can pass it on to their client, or they can take it as a little bit of a commission for them.
Bingo. Thanks.
Awesome, man. Talk soon.
Juniper Square, the sponsor of this show, recently conducted some research to help you understand what real estate investment managers are doing to build stronger relationships with their investors and earn more referrals to new investors. Their new special report includes data on topics such as what factors are the most important for building investment relationships today, how technology is being used to provide a competitive edge, and the one technology integration that is driving more repeat investors and more referrals. To download this for free, visit junipersquareresearch.com. Again, to get this report for free, visit junipersquareresearch.com. Before you go, we have a new sponsor of the show, recostseg.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single family rental, a short-term rental, or a large commercial property. recostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit recostseg.com to learn more.